spent the past couple of years in a crazy hot market. Louisville home sales decline as demand outpaces supply. Effective communication is at the core of any situation. If you master these two ideas, you'll have a chance of being successful at residential real estate marketing. I think you need to be looking for investment opportunities that move the needle. The market will never crash if demand exceeds supply. This is what I've been telling you all along.
This is the Jay Pitts Show. And we're back, folks. Welcome back to the Jay Pitts Show. I'm your host, Jay Pitts, right here on Talk Radio 1080. I am here for the second week in a row with my guest co-host, Mr. Luke Andrews.
Yo.
Ryan Harris is still out having the rest of his baby moon. We wish him well, him and his new young family, his new young son. I'm not going to put the name out there. I don't think that's appropriate. I think he should say that coming back
I think
afterwards.
So.
Also joining us today is one of our amazing sponsors you get to hear from every week. I don't know that you actually hear his voice. You just get to hear me talk about how great he is. I'm going to do my best to make him blush. And maybe just catch him off guard, see if he's got something to say. Mr. Andrew Dow of Motto Mortgage Premier Partners.
Gentlemen, thanks for having me.
Absolutely, sir. Absolutely. So it's a pleasure that we get to have such a brilliant mind in the world of finance join us here today with Luke and I and our E-Town lingo. He'll try to confuse us and really just remind us why we just trust him and allow him to work with our clients and we stay out of it. But we're going to talk about some finance today, some finance. I often say that a real estate agent should know two things very well in order to be successful. They should know how houses work. It doesn't mean you have to be an electrician. By the way, don't grab, an open wire, especially not if it's 220.
110's fine.
110's good. 110 give you a little,
better than a cup of coffee.
A little better than a cup of coffee. 220 is night and maybe for forever. So don't grab 220, but you need to know houses. You don't have to be a licensed plumber, electrician, or HVAC, but understand basically how they work. And you need to know finance. So I kid when I say I know nothing. I know nothing compared to Andrew, but I know more than most realtors. So today we're going to cover a few topics in the world of finance and financing for home buyers. So we'll get to that here just in a few moments. But really, I want to cover on just like what exactly we're going to discuss today. So we've got in that world of finance, we're going to talk about why consumers feel rate locked, right? Rate locked is a term that I've recently heard kind of develop. The article in question really says, why Americans feel trapped in their homes by their low rate mortgages, which, is first world problems if you ask me. But rate locked is not the rate lock, like locking in your rate before you purchase. That's what we've always known rate locking to be. But rate locked meaning you can't sell because rates are at 7 and you're financed at 3. We're going to talk about that a little bit in the article, that Andrew provided for us here. We're going to talk about baby boomers and wealth. I said I would do it in segment 4 of last week's episode, substantiate my claim, which was wrong, by the way. I can admit when I'm wrong. Still pretty staggering, though. We're going to talk about how baby boomers affect wealth in this United States and in the world. We're going to talk about why, again, loan rejections have reached a 5-year high. You heard my answer on it a few weeks ago. We're going to get Andrew's take. We're going to have him school us on loan level price adjustments, which is another thing that we discussed on a recent episode. And maybe we'll have a little fun in segment 4. But for now, we're going to go ahead and jump right into a question from the field. Luke, what you got for me today?
So what I've got a question, again, from one of these real estate Facebook groups. We've got agents. Agent has a client who is considering buying a foreclosure property, something on HUDHomestore.com. Now, they've got a lender that's telling them that it's okay as long as the house is, quote, livable. But the agent is asking, what else do I need to know from a financing perspective? How do I guide my clients if they're looking at purchasing a foreclosure?
Man, that's a great question. The main thing that most appraisers and financing companies will look at when they get that appraisal will be safety, soundness, and structure. So if you're in a situation where there's financing required and an appraisal is there, you just have to make sure that there's no visual evidence of mold or lead-based paint or chipping paint or anything along those lines. Flooring has to be in and no subfloors where there could be risk of splinters or nails or anything along those lines. And obviously the soundness and the structure no sagging floors, no issues in the basement where joists might be not supported correctly, those types of things. So, the appraisers will do more of a visual inspection, but there are certainly minimum property requirements that exist that will present some challenges, on that financing side of things. So any type of foreclosed homes are going to have those challenges, and it's important to get ahead of that.
So what about the ones that you see where it's like, hey, get this house for $100 down?
So that's a different scenario. That's usually a HUD-owned home, and in that dynamic, it is 100 down. HUD has foreclosed on that property, and they own it. They're trying to sell it. There's also money that's being set aside, which is called an escrow holdback for the necessary repairs on that. HUD will not fix those issues prior to the closing of that sale or anything along those lines. They make it affordable for the buyer to be able to get into that, but those fixes after the fact have to take place before it actually becomes livable. But HUD determines what those fixes have to be prior to the completion of that transaction.
I was going to say, like when I heard this question originally, like I had bells going off in my head when I heard the word livable. Like it's just like subjective. Like it's not subjective though. It's objective. It's just who's the person that stands in judgment. And what you've just explained to us is the appraiser.
Yep.
It also depends on the type of loan, which, like as you said, they do have special financing available for owner-occupant FHA buyers to take over these once FHA loans. HUD Home Store is the disposition site for the Department of Housing and Urban Development. It's how they sell their properties that they foreclose. So obviously those have different regulations than a conventional loan. Can we discuss the difference between quote unquote livability from an FHA or a VA to a conventional loan?
There's not a significant difference. I think there's a misconception that an FHA appraisal is significantly more complicated or a VA appraisal is significantly more complicated than conventional. You can use an FHA appraisal for a conventional financing. You can't do it vice versa. So, there are certain things that an FHA appraiser checks, water, utilities, those types of things that are not necessarily done on the conventional side. So because those properties are generally more geared, especially on the governmental side, for primary residence, owner occupancy, the property requirements are a little bit more stringent in order to be able to make sure that it happens. It's a little bit looser on the conventional side because they do allow for investment properties and that aspect of it. So there's not necessarily quite the requirement from a true livability. It's more of a collateral side.
Nice. Okay, so we understand that there are people that stand in judgment in terms of livability. I mean, is there anything else we should know about financing foreclosures? Maybe we can expand. We don't even have to stay with, HUD Home Store or FHA. I mean, I think that's the answer, but so many agents, and if you listen to investors or the Real Estate Investor Association crowd, we're in the midst of a real estate crash. And there's going to be all this inventory. We're going to magically go from 2 months or 1.5 months of supply to 8 months supply. And there's going to be this wave of foreclosures, even though unemployment's at 1.9% or whatever. Like when we're financing bank foreclosures, if that becomes more of a thing, is there anything else we need to know besides the condition question?
Not really. I think the bank foreclosure becomes a little bit more complicated because you're adding another layer to the loan approval, whether it's a short sale or whether it's from the bank. They've got to be able to approve what they're willing to sell it for, and those types of things. And that's really what a lot of the problems were back in 07 and 08 when we had our major crash, right? And that big recession, at that time. So, there's, hopefully the property condition is in a spot where somebody can inhabit it. Again, if there's walls falling in and windows exposed and those types of things, it's not going to pass that financing side, especially on conventional. If you look at it and you say, hey, nobody can realistically live in that house comfortably. There's no heat sources. There's, mold that they could be sick or whatever. It's just not going to go from a standard conventional and financing channel.
And so who do you refer them to in that moment? If that's not a loan for you, because that's not really what Motto does, who do we refer them to?
There's a handful of hard money lenders that will provide renovation loans, short-term loans to be able to get those fixed up, where you can do minimum property requirements and, you can communicate that to the clients from this is what needs to be done, short-term loan, and then you can do the end financing once they've acquired the property. There's some banking institutions in town that do rehab and renovation loans as well, and so there are outlets there, and that's what we try to do on the Motto side is that we have a lot of solutions for the clients. We don't necessarily have solutions for all of them, but I can help find those outlets where it's needed so that if it's the right house for the customer, then we can make it happen.
Sure. Well, I think that's just about all the time we have for segment one. We're going to be back just after the break. You might even actually get to hear me talk about Andrew on the break. Not really sure if that's this break or not. But after we get back, we're going to talk about why so many Americans feel trapped in their mortgages by their low rates they got in the last few years. Once again, I am Jay Pitts, host of the Jay Pitts Show here on Talk Radio 1080. For Luke Andrews and Andrew Dow, we'll be back real soon. Give us a moment. We'll see you in a minute. And we're back, folks. Welcome back to the Jay Pitts Show here on Talk Radio 1080. We're going to go back to Andrew Dow here for a moment, guest here with Motto Mortgage. Luke has been uncharacteristically silent in the first sec. No, I'm just joking, Luke. We got schooled is what happened. Every time Dow talks, I'm just like, shut up and listen.
Well, it's just being here with the two of you. I'm honestly not even sure why I'm here. It's like I'm just the short, ugly guy in the middle who doesn't have anything to contribute. But I can sit here, I can learn all day, listen to you two all day long.
I love Luke in a meeting or in a setting like this because he brings like really good snark, and then he's like self-effacing like 1 minute later.
Well, and it's really hard for him to get a word in edgewise between the two of us because we can also start chatting pretty quickly.
This is also true.
There's a lot of words when you and I get in a room. So,
Well, considering you two are both like 6'5" plus, and I'm over here at 5'8" on a great day.
I was going to say, are we going to be generous with that?
Yeah.
I don't know.
It's like the toddler running through the studio here.
I think 5'8" is. I think 5'8" isn't so generous, Luke. You're probably a solid 5'8".
Sure.
Do you like that soft pivot away there? Okay, let's get to this article. Why so many Americans feel trapped in their homes by their low rate mortgages. This came out on August 1st on CNBC.com. Key points at the top of the article. The recent spike in mortgage rates has created a so-called golden handcuff effect. Hadn't heard that one yet. And nearly 82% of homeowners feel, quote unquote, locked in by their existing low rate mortgage. In the meantime, the shortage of homes is pushing for sale prices upward, which of course this is what we said. Guys, you guys haven't been here, but I know you've probably listened to the show, maybe. You would have heard Ryan and I talk about these very same concepts almost on the regular. I think Jim's over here nodding his head a little bit too. They cited a man by the name of Bob Wood, who's 66, and he's been thinking of selling his home in Mobile, Alabama. He's a finance professor at the local university, his wife Terry, and he purchased a 5,000 square foot house with a pool about a decade ago, and it's time to downsize. Okay, they'd like to get closer to their grandchildren who live in Tennessee, but yet they're in the 10th year of a 3.125 15-year mortgage, which means they got 3.125% locked in for an additional 5 years, right? And they just don't feel like it's possible to move right now and then go finance their replacement property at substantially higher. And it goes on to say he's one of many, which is true. I've heard a bunch of statistics on this. The article then goes on to state that there is a tipping point of 5%. After bottoming at 2.93% in January of 2021, not sure if that's exactly correct, but we'll grant it. As the average rate for a 30-year fixed rate mortgage, we're currently sitting at around 7 on bankrate.com. And basically, Wood and many others see that rates need to drop down to closer to 5% flat before it makes sense for them to make a move. The article then goes on to continue and compare the market to that of 1978 through 1981 mortgage rates, where they doubled, but they went from 9 to 18%. I think we're in a very different situation than we were then. Okay. And, it says, again, not shockingly, that rates may not return to sub 3 levels anytime soon, if ever, probably never. So I guess the question that this all begs is, where's the relief? Where's the relief? These are 30-year fixed rate mortgages in most cases. In this case, his 3.125 on a 15-year is not anywhere near the bottom that I've heard.
Not on a 15, certainly. I mean, there was 30 years that were below 3, and
yeah,
usually you're at about, there were some 2% and 1.875s that were probably transacted
on 15s.
On 15s and 10s. Yeah.
So I mean, if we talked about baby boomers last week. And we're going to talk a little bit more about them later in today's episode. If they hold a substantial portion of the country's wealth, and the world's wealth for that matter, and a lot of it is tied up in real estate. And they've already proven, prior to the unicorn years of 2021 and 22, resistant to downsize as expected. And now they're financed at 3.125% or below. Or let's just say sub 4, right? And they have all this equity because they've been able to get the benefit of the rise in prices that we've seen. We need that inventory. The market is starving for it. But I don't see any relief in sight.
Yeah, and I don't know that there's a quick piece of relief that's coming. I think from an inventory side, especially on the boomers, a lot of them moved to 15-year mortgages in 2020 and 2021 when rates were at the historic of historic lows. And I think that article is right. We'll never see it again. I think maybe what some of the forward thinking process is that when you're in those higher, in the shorter term amortizations, your monthly payments are higher. And the one thing that I've always looked at from a financing side of things, and I'm not a financial planner or analyst, but I do understand a lot of the concepts. Equity is a relatively stagnant asset. So you can invest that money and create a higher rate of return by having that in different investment vehicles as you're either in retirement or nearing retirement age, even that aren't necessarily aggressive, where you're trying to accumulate a significant amount of wealth when we're in our 30s and 40s. I just think that if boomers were to look at that, knowing that they're also getting into fixed income scenarios, minimum required distributions, everything else out of whatever retirement plans that they might have, that 10 and 15-year mortgage isn't necessarily as important for them, because you could finance the remaining 5 years off of that on a 30-year and change your cash position significantly when you get into the fixed income side. So as I've always said, it's about payment. It's not about rate. I understand that we've created this artificial utopia as to what, long-term debt should be financed at. The reality is that there's other ways to be able to leverage that equity, in my opinion, especially in a downsizing situation where the higher interest rate may not necessarily equate to a higher monthly payment. You just amortize it over a longer period of time, knowing that you have the cash position in other investment vehicles to pay that mortgage off if you ever wanted to, or you could take advantage of a refinance if and when rates drop in, the next 18 to 24 month period.
Yeah, I see all that. In fact, it begs a question. I saw a video the other day and I discounted it. I'm going to have to find it. It's one of these would-be financial gurus on the short form videos on the socials, right? And basically his contention was, it's time for a new financial product. It's a new mortgage product to allow people to transfer existing mortgages to new properties. And I can't say that I'd ever considered that before, but it's not completely and entirely far-fetched.
So it's kind of like an assumable, but you get to keep it. You assume it to another property.
You take your mortgage to the new property, and then you finance the balance of whatever is needed in a second note. Okay, or I suppose it could even be done in a blended type situation, right? That's not that difficult of a mathematical consideration. But let's say your bank wants to keep you. They want to ensure that you don't go down the street and get financed with someone else, right? And I recognize that this erases a bit of the dirty little secret that is the mortgage industry, which is that amortization is front loaded. Okay. Interest is front loaded in amortization, and homeowners tend to sell and buy every 7 years. And so you're always paying a substantial amount of interest rather than retiring a lot of debt. But, desperate times call for desperate measures. And it would be very interesting to see that if a bank would have the foresight to grab share of market. But I think they know what's going to happen. If you're first to market, you're not, because you're going to get copycats. And so then the industry just basically gives up a ton of leverage by allowing you to take your 3.125 to the next house. And yeah, it's only $200,000 and you're buying a $800,000 house. So you got to go, you're 20% down and you got to borrow the balance at 7%. But interesting. It's an interesting thought nonetheless to solve the rate lock problem.
The problem though is that banks would much rather lend that money at 5 and 6% than they would at 2%. So
agreed, but
whether they're going to take their revenue at 2% over the remaining 15 years, or whether they're going to do it at 3% over 30, they would rather have that interest income in perpetuity, and they would much rather have that at the higher rate. That takes out of the complications of, okay, well, how do you collateralize the new house? What steps go through that in order to be able to transfer it, certain equity positions and things like that. Yeah. And you also have a recorded, mortgage that's out there that is tied directly to that property that don't have any partial releases or anything like that. So it gets into some legal weeds.
It could be done, Andrew. It could be done. It could
always be done.
It's a matter of will and preference, not ability. We know that. But, it's just food for thought. It's food for thought. I guess we're not going to get to the baby boomer generation. Let's tease it before we go to the break. So I said that 70% of the world's wealth was held by United States baby boomers. I was incorrect. It's 30%, which is substantially less.
Still a lot.
It was more than half.
And it is twice that Jay's admitted he was wrong on this show, by the way.
I do it. So
is your wife listening?
She does listen, so she knows that I'm capable. Whether I do it at home, actually, I don't know that she does. She hears my voice.
She doesn't want to hear you outside of.
Let's be specific, okay? The world's wealth, $463 trillion. Okay, the baby boomer generation in the United States alone is $140 trillion. We're going to talk about the relationship of baby boomers to the United States wealth after the break. And we're going to have a little bit more discussion about the baby boomer generation as it pertains to real estate. But that's all the time we got for you in this segment. We're going to cut to a few sponsors, and we will catch you after the break. And we're back, folks. Welcome back to the Jay Pitt Show here on Talk Radio 1080. Just before the break, we talked about baby boomers and wealth. But I have to tell you, you missed the best joke of the episode. Luke decided to unleash the baby boomer assumption on Mr. Dow here, who, despite the gray hair, is very much a Gen Xer.
Very much a Gen Xer.
Very much a Gen Xer by a solid 2 or 3 years. He's got a few years on me. I said,
which side solid 2 or 3? Like 2 or 3 from boomer, or 2 or 3?
He's 2 or 3 closer.
Millennial?
He's 2 or 3 closer to boomer than I am.
Yes, but
it might be 7 or 8.
Clearly Gen X.
Is it 7 or 8?
It's
where are we
8,
at?
I think.
You're 8 years older than me. Yeah. But he has a baby face. So the hair, don't let it fool you. He's got a lot of salt and pepper, but he's got the baby face going.
Well, an 18-year-old daughter, a 16-year-old son, and my lovely wife all contribute to the problems.
Oh, ouch. Well, we're going to have to send a link to this episode to Christy so she can hear that straight from your mouth.
Well, can I ask?
Yes,
is it
please.
Sorry, I keep wanting to say boomer. The mid-level Gen Xer, is that the primary driver with the green bubble, the green dot?
Oh. Let's discuss the green bubble.
Well, because earlier in the show, when we talked about, kind of sharing articles back and forth, you said, Andrew, did you text me? And he's like, no, I emailed. And I thought, there's no way he can text you. You can't. I don't think you can text an article from a green bubble, can you?
Well, I get crucified on this Android phone all the time, but I did see an article the other day that did say that those that have Android phones are much more humble and empathetic than those without iPhones. So they're
Android.
That was written by somebody with an Android, probably from a T-Mobile Sidekick or something.
Hold on here. Android users, the Google autofill. Okay, I find this humorous at times. Android. I type in Android users have the first pop up is higher IQ. Let's check. Let's see
Check
what that
that
says.
box.
And what was the source on that? What search engine were you using?
The research results. I'm not joking. There is no evidence to support the claim that Android users have a higher IQ or intelligence level. Sorry, guys. Jim, I'm sorry to clap, man. Hopefully you don't have to cut that out. It was just too good. All right, let's get back on the saddle here. Okay, so we were talking about baby boomers and the great wealth transfer as coined by the New York Times in an article where they talk about the baby boomers and wealth. So half of the nation, United States, is held by baby boomers, right? 30% of the world, what does that tell you about the United States and, the amount of wealth they hold with relation to other countries? I digress. That's not what we're talking about. But baby boomers born between 46 and 64 hold 30% of the world's wealth and 50% of the nation's wealth. That's pretty staggering. Okay. And so what brought this to the forefront in the last episode was we were discussing how supposedly Gen Z is about to seize control of the real estate market. And the basis for that was that they, at an 87% rate, express interest in home ownership, which is like the highest interest level on record in home ownership of all the generations, much higher than the millennial generation. I would submit that the millennial generation was the age of Gen Z when they were surveyed, and that has flip-flopped substantially. In fact, according to many sources, but I know specifically the Zillow Annual Trends Report, the millennial generation has north of 25% of both buyer and seller markets currently, and is the largest segment. There's, boomers and X are pretty close, but I think millennials, as of it probably at least 2020, millennials made up the highest percentage of sellers and buyers. And my contention is that they're going to inherit the greatest wealth transfer in the history of the world, especially in this country. And they're going to continue to drive all markets, not just real estate, for the distant future. Now, I am an old millennial. I was born in 1981, which I think is now acknowledged as the very first year. It was originally like 1985. They keep editing backwards. But, I don't necessarily identify with the millennial generation as much as Gen X on a lot of things. I was born in a house with a rotary telephone, right? We didn't get internet, and it was dial up until I was probably in 7th or 8th grade. So I guess my thinking is, what do you think, either of you, Andrew from the finance perspective, Luke from real estate or investing or any of that, what kind of impact does this have on real estate? Right? Andrew, if my generation is going to inherit $140 trillion collectively, what does that do to mortgage borrowing?
I think it's going to present a huge challenge. Again, depending on the allocation of the wealth.
A lot of it's going to be that real estate, that paid for real estate that they own.
Correct. And, so the only way to, I guess there's two ways to look at it, right? Maybe it opens up a potential cash out refinance market, because the only way to access that equity is to be able to, refinance the existing loan or to take out a home equity line. So there's going to be that. I also think there's going to be challenges those too, because if that isn't necessarily tied up within the real estate and they're getting that in different distributions from 401ks or different retirement accounts or anything else coming into that cash position, is going to leverage the volume significantly, because there's either going to be larger down payments or a lot of cash transactions that happen. So it'll be interesting to see which side that goes. But again, if rates stay high, people aren't going to want the payments. And if they've got the cash, the perception is that it's better not to have a payment than it is to have a payment. I feel counter to that. I feel as though that money should be invested someplace else and you can borrow it, because you can still usually outrun the rate of inflation on just, kind of what the historic market trends are in different investment accounts.
Okay. Luke, what you got, man? Anything on that? Any comments?
Looking at it, I think investors are going to find a way to try to capitalize on this. Mm-hmm. And they're going to look at these older homes that probably haven't been touched or renovated in 25, 30 years. They're going to be licking their chops in these nice established neighborhoods that they can do some quick cosmetic flips because they know that generation is one that takes care of the bones of the property. I could see a situation where investors are coming in because it seems like the baby boomers, they've got options. As prices continue to rise, they've got options for cash flow in terms of like a reverse mortgage or something like that. But they seem to be hesitant to take those. But I can see investors coming in and just saying, hey, look, I'll give you the cash on the front side. Not even necessarily an annuity. I'll just give you a lump of cash on the front side. But then I've got an option to be able to just take your home at your passing.
Yeah.
Going ahead and buying it, but allowing you to still live there. Very similar to Hef in the Playboy Mansion, right? He sold it, got the cash while he was still living, and had the right to live there until he passed away. Yeah. And then all of a sudden the investors can come in, they can gentrify, and then drive up the values.
Fun fact, Gary Gold sold that. Gary Gold is a member of Luke and I's network of real estate agents across the country, and that was a really unique transaction. I don't know that many that had been done
right
to that level at that particular time. Really, really interesting. But no, I see that. I think that paid for real estate, that maybe that 4,000 to 5,000, 6,000 square foot house that is really expensive to cosmetically renovate, that keeps a lot of like move up buyers out, right? Lifestyle wise or whatever. I mean, I've said, and I personally did it. I said, look at established neighborhoods, larger homes. If you want your forever home, buy it cheap and renovate. Now that was 2019 prior to the run up.
Sure.
So I beat the market there, and I financed at 2.625 on the back end of that. And Mr. Dow helped me do that. But just unique challenges, and I was curious to hear your all's opinions. So, all right, let's pivot from boomers and let's talk about loan level price adjustments. So, Andrew, it was my contention, right, that loan level price adjustments were meant to incentivize entry-level purchasers, recent change, right? We're meant to incentivize, low-level purchasers because demand is pricing so many out, right? These don't make homes more affordable for those people because really all we're seeing is smaller adjustments at lower credit ratings and less desirable loan terms. The 780 borrower with 20% down, jumps down to a 760 credit score, and my example was they might get a 0.25 point hit on their rate, whereas a drop from 680 to 660 might only be an 1/8 decrease. So my question to you, okay, and we've got an article here and I can cite some of it in just a minute, but where did I get that wrong?
Well, the loan level price adjustments have always existed. It was a really hot topic back in April, but the reality is that the new adjustments that existed were implemented back in January. And they've always existed prior to that. They just made changes to it.
Of course.
And, I think the biggest thing to understand is that rate is always a measure of risk. And so what they've tried to do, at least at the Fannie Mae and Freddie Mac level, is to try to encourage or at least make money available to that middle credit score borrower at a less expensive rate than or a less expensive outgo than what it previously had been.
Yeah.
And, frankly, I think it's just kind of posturing to a certain extent because it had just been so punitive for individuals not putting 20% down at 640 and 680, where FHA didn't make a whole lot of sense because you had monthly mortgage insurance that came along with it. And if you had that 20% cash position, you didn't need to pay MIP. So, that dynamic is one that is there. But I just think that you're still better off in that mid-level side on FHA because you just don't have the same price adjustments and the cost of the credit is just much more affordable.
Right. All right. We're going to continue that after the break. We've reached our limit for this segment. We're going to cut to a few sponsors and get a little more detail on that punitive talk that you were talking about a minute ago. I want to hear more about that after the break here on the Jay Pitts Show on Talk Radio 1080. And we're back, folks. Welcome back to the Jay Pitts Show here on Talk Radio 1080. Before the break, we were finishing up talking about loan level price adjustments. And, that comes from an article from Mortgage Rate Watch, Andrew provided me that I read before we came on the air today. And it basically says, is there a new unfair mortgage tax on those with high credit? It's kind of an oversimplified explanation. And that's what headlines do. They grab attention. And that's kind of what Andrew was alluding to before. And like you said, it's posturing. A lot of the news coverage has been posturing because these things have always existed, right? It's just they have kind of had maybe a slightly historic turn, okay, where the loan level price adjustments have not increased for lower credit borrowers. They've decreased, actually. And they've increased for higher credit, higher qualification borrowers in some senses. But I think the justification that we're getting, from the top down, right, from the Biden administration all the way down, and the PR that surrounds this is, the quarter increase that the high credit borrower endures from a 20% drop in credit score does not prevent them from having home ownership. And the profits supposedly earned from those higher rates can then be used to subsidize, if you will, that's not the perfect word, but allowing, or making credit available to those that may not have always qualified. Is that kind of in a nutshell what you're seeing, Andrew?
Yeah, I think, the easiest way to understand it is that, the gap between what a higher credit score borrower and a lower credit score borrower shrunk. And so when you've got, and again, I think there's a certain dynamic that exists with it too. Fannie and Freddie aren't dumb. They understand that there's a refi boom coming at some point. If you make the cost of that credit just a little bit more, they can get a little bit more money up front, knowing that they're going to lose that in interest income when the refi boom happens and they drop. So
see, nobody's talking about that.
No, absolutely
nobody's talking about that. They know the savvy borrower that's going to pay an extra 8 today and for the next 3 to 4 years when they're financing at 7.25%, right? That they're going to refi as soon as rates hit 5%. In fact, Robert Refkin, the CEO of Compass, in an article that we talked about earlier, I didn't quote this then, but says that he expects a glut of inventory to hit the market as soon as rates hit 5%. I don't believe it. But everybody's talking about 5% being the threshold. I personally think it's almost 6.
But a glut of inventory hitting the market, it's still going to be one for one because there's going to be a buyer
there's going to be a sale for each one of them.
There's going to be somebody that's coming in and buying. And so that's like what you were talking about earlier when you said that it's somewhat less favorable for these people that are getting opportunities to get loans when they couldn't prior. But that's still putting more demand into the market that is already struggling, which is just driving prices up further and further. So is it really helping the problem? I don't know.
I mean, I really don't think it helps. And honestly, I don't know a 5% number, if that's the magic number. And I've heard the same one too, right? Like whatever it happens to be, we've had it in different conversations, Jay. What you pay for the house right now is what you'll always pay for it. You always have the ability to refinance off of that. Yeah. And, when you do the math on, again, let's say that there's a glut of inventory, there's still a lot of pent up demand. So when you have the inventory go and then you have a bunch of pent up demand and we don't really know what that number looks like because there's a lot of people that are sitting on the sidelines, it's still going to be a supply and demand model. So you're going to have people that are going to pay more for their houses. And they're going to outrun what the difference is in the rate change because it's going to be in that hyper competitive mode that it was back in.
So your payment's going to be the same. Your rate may be lower, but the price that you have to pay is higher. Your cost of entry is higher, so your payment is the same.
You pay payments, you don't pay rate.
Exactly.
And I think again, it's an adjustment to the market, right? And the media never does us any favors with any of that because all they talk about is rates are going up, rates are going up, rates are going up.
Okay, the housing market's crashing.
Right. So everything is going, it's just a complete mess and you have no business in home financing and pack your bags. And it's just not the case. It's just a matter of making astute financial decisions that you can put yourself in a spot where you can still afford the loan. You will always have an opportunity to refinance. You're still going to be able to gain equity. Like there's no better time to still buy a house, regardless of where the interest rates are, in my opinion.
No, because it's going to be more later.
Exactly.
I mean, that's the thing. And we saw that in the last couple of years. It's been my contention all along that we should be incentivizing sellers, not buyers. We shouldn't do tax credits. We shouldn't do, reasons for people to buy, because when you have no supply, all you're doing by increasing demand is driving prices up, eating into, the incentive that you've created. It just perpetuates the cycle. We need to be extending capital gains exemption limits. We need to be, incentivizing small builders. We need to be doing things that allow the creation of inventory. I digress. It seems like everything we do, procedurally, from the government, on down, it just perpetuates the cycle. It makes me wonder who profits from the cycle, but that's neither here nor there. All right, let's get into some fun stuff, because we're halfway through segment number 4, and we've got about 5 minutes left today. So here's what I got for you guys. A couple of hypotheticals. First, we'll start a little light. If Jurassic Park were real, would you visit?
Absolutely.
Absolutely. Yeah. Okay, hold on. Not like Jurassic Park 19, like Jurassic Park 1. The very first movie with the guy, the Newman guy from Seinfeld, when the thing came out and it spit the black stuff on him and he rolled down the hill in the rain. Like that one.
I'd go in a heartbeat.
Not the amusement park that they made it later on. You'd go.
I'd go.
Would you?
Well, I'll preface this by saying that I never saw the movie.
You never watched Jurassic?
Never watched Jurassic. Just wasn't interested in it. But I've seen the previews. I know what it's all about. Yeah, I'd be there in a second.
Oh my gosh. I don't think you can say honestly that you would go if you've never seen the movie.
I've never seen Star Wars either.
Like, this is almost as appalling as his green Wait, what? No Star Wars either?
Never seen Star Wars.
And he's got a green bubble and you're making fun of him?
Yeah, well.
Oh my Lord.
Yeah, you tried growing up with a name like Luke as Star Wars was just outside of I heard it enough. Didn't want to watch it in my free time.
All right, here's another one, a little more serious. If you could be the CEO of any company, which one would you choose?
Ooh, that's a good question.
Remax Premier Properties.
Ooh, zing. You could. You just have to take me out. Yeah. So no, for real. So Avalanche, Colorado Avalanche.
That's what I was going to say.
He'd be the GM of the Colorado Avalanche.
Zip me into something hockey related in the NHL, something maybe a baseball team.
Would you be NHL commissioner?
No, because that guy gets booed unnecessarily every time he shows his face in public. I don't understand that, but
like Goodell gets booed. I mean, NFL is a money printing machine.
I don't know that I would necessarily want to be the commissioner, but I would be more than happy being one of those filthy rich owners that just gets to go to the luxury box and watch hockey every time their team's in town. So I'd be in on that.
Okay.
For me, it's a sports or a talent agency. It's just something about the agents. It was just, I was always fascinated by it. Now, Jerry Maguire, a movie I have seen.
I was going to say, I was guessing Ari Gold from Entourage. Yeah. He's an Ari Gold guy, I can tell. Short little man syndrome. Sorry. All right, Luke. Seriously, no, you would be a sports agent? That's not a CEO, but you could be CEO of
the agency. CEO of the agency, but I'd love to be an agent as well.
Okay.
But I do know an agent personally, and it doesn't seem as glamorous as they make it out to be on TV.
Y'all are going to laugh at mine, and this may be obvious because I'm me, and you guys know me both know me pretty well. I'd be the CEO of Tesla. I don't want to be. I don't want to be Elon. I mean, I wouldn't be that guy, and it probably wouldn't be Tesla because it'd be a lot more boring if I was the CEO. But that dude, just like that job, it's just so gnarly. And I'm driving a Ford Lightning, by the way, which I probably need to do. Hannah, we need to do some content on the Lightning, but it's not a Cybertruck, which I am in line for, frankly. We'll see. I think I'm 1/1,000,000th on the pre-order list, so it's going to be 4 years before I get one, and the Lightning will be ready to be traded in by then. But it is such a rocket ship, and if Ford can make that, I can only imagine what the Cybertruck is going to look like. All right, let's see. Let me get you one more before we go. If you Well, let's see. I'm going to go here. If you could have one superpower, what would it be?
Fly.
And we got 1 minute.
Fly.
You want to fly?
I'd want to fly.
Like Superman fly?
Just fly. I don't know. Yeah, Superman fly, float around, just get from A to B. It's
Okay.
like my own little personal helicopter.
I mean, I would probably have to do the invisibility, just simply because.
Andrew, that's dangerous.
Man, you know me in the public spotlight. It just kind of naturally fits for me to get there. Anyway,
Andrew wants to disappear. He wants to disappear just so you can, not so he can see you, so you can't see him.
I could just be the voice in the back of your head. That's all I need to be.
That's funny. All right, so I will say that I'd like to be, this is funny. Like my 3-year-old, he tells me I'm stronger than the Hulk. He's like, Daddy, you stronger than the Hulk? And I was like, actually, buddy, he's fictitious. But even if he was, that's definitely not. So I'm not going to do the Hulk. I'm going to say the Flash. I just want to be fast. Like that would be really cool.
That would probably
Hence
be
the Ford Lightning.
Hence the Ford Lightning. Now, have you seen the Zack Snyder's Justice League? Like, have you seen the movie? It's a good movie. We're into superhero movies. I got an 11-year-old. And the Flash, like, he goes so fast that time stands still. It's just kind of cool. All right, folks, that's all the time we got for you today. Really, really appreciate Luke sitting in. He may be here with you next week. You never know. Andrew, thank you so much for lending your expertise and knowledge here on the mortgage front. I am Jay Pitts here, host of the Jay Pitts Show for Luke Andrews and Andrew Dow. We will catch you next time.